Today's show is sponsored by Equinix. We all utilize multiple cloud providers, and we know they aren't built to work well together. Things get a whole lot more complex when your hybrid infrastructure needs to connect with your multi-cloud portfolio. Equinix is the world's digital infrastructure company, providing on-demand infrastructure in over 25 metros, with hands-free provisioning and management, all connected to over 240 data centers and most major cloud providers. Equinix can help you deal with increasingly complex architectures, whether you want to run your favorite Kubernetes distribution or connect workloads between different cloud providers. To learn more, sign up at deploy.equinix.com and use the coupon code CLOUDCAST, CLOUDCAST, to get $500 in credits to get started today. That's deploy.equinix.com and use the coupon code CLOUDCAST and get those first $500 in credits today.
Cloudcast Media presents from the massive studios in Raleigh, North Carolina. This is the Cloudcast with Aaron Delp and Brian Gracely, bringing you the best of cloud computing from around the world.
Good morning, good evening, wherever you are, and welcome back to the Cloudcast. We are coming to you live from the massive Cloudcast studios here in Raleigh, North Carolina. Hope everybody is doing well. Middle of June, month is continuing to go along. Big weekend for both Aaron and I. Both of us have kids who are graduating from college. Aaron's second child, my first child graduating. I'm not from college, from high school. Gosh, we're not that far along, but yeah. So big weekend for that. Kind of one of those think back moments. I know when we first started the podcast, the kids were really little. They were, I think, just starting elementary school. Every once in a while, we would have them come on the podcast. They had no idea what it was. It was just a big microphone. But yeah, so it's kind of an exciting thing. Both of us are going to each other's daughters' high school graduation party. So that's kind of fun. Another Sunday Perspective show. And this one is I think going to be sort of interesting. Again, we always try and connect a few dots. And one of the things that Aaron and I talked about both at the North America, so the Detroit KubeCon, as well as the Amsterdam KubeCon, the one here in the spring, was, how many companies there were in sort of each category, whether it was Kubernetes distributions or monitoring observability or software supply chain or, you name it, service mesh, whatever it was. There were not one or two companies there where you're sort of picking the winner in second place or whatever. There were 6, 7, 8, 10 companies in that domain. And what sort of jumped out at us was we said, boy, it's really hard to tell the difference between those companies. What does this one do different than that one? Who is that company? I've even heard of this 6th, 7th, or 8th observability company that came walking along. And, we had talked about, it felt like the market was sort of overcrowded and so forth. And that was fine, right? It was kind of the result of a lot of low-cost money, zero interest rate money, if you will, sort of the Unicornpalooza of 2019 to 2022. And that was fine. And then I saw an interesting article this weekend in the Wall Street Journal talking about some venture capitalists private equity companies. So again, the difference between obviously venture capital, the guys who put money in on the front end of companies being built, private equity, the folks who are putting money in and buying up companies once it seems like their sort of independent growth era has sort of come to an end, if you will. And the article had a really interesting sort of highlighted quote, and I put this in the show notes. Software companies taste like chicken. They're selling different products, but 80% of what they do is pretty much the same. And it sort of dawned on me that, yeah, we're unfortunately or fortunately beginning to get into that era in which the market kind of corrects itself to a certain extent. And it kind of dawned on me that we are also beginning to get into a stage in which, because open source is so prevalent, but also SaaS is so prevalent in how we, use and consume software, that it feels like the middle of the software industry, sort of, the edges, the far, big and small of the software industry can survive and thrive, right? You get these sort of mega platforms, whether it's the big three cloud providers or a Red Hat or a VMware or a Salesforce or an SAP or something, an Oracle, large platforms that can have multiple functionalities, can acquire a number of things, can do a lot of stuff, are sort of on one end of the spectrum. And on the other end of the spectrum is what's becoming lots of very niche sort of SaaS offerings, right? I guess on the big end of the spectrum, you'd have companies like Datadog as well, and to a certain extent like a Snowflake or somebody like that. But on the far end of it, you can literally find SaaS companies that do, one thing, what literally feels like just a feature. Oh, they are a SaaS tool that does, keeps track of your calendar or integrates with your calendar and lets you do, multi-group things or whatever it is. But the middle of software, the things in which, it's sort of, we're not really a platform. We're not really a tiny niche. We're not part of one of the, really big companies. We're sort of stuck in the middle. It feels very much like, as we've seen in many parts of the economy, it's kind of hollowing out. And I think what this private equity person is sort of saying, and what we sort of saw with KubeCon to a certain extent, is, we have this big middle of software that's having a really hard time differentiating itself, that there is a ton of competition. There is a ton of funding that may or may not be good funding, maybe overvalued funding, whatever it might be, that is potentially going to, as the economy is now shifted to, non-zero interest rate money, potentially going to have a challenging time. And I say that in around software, because obviously we've seen in hardware, huge consolidation over the years and so forth. So I want to kind of dig into that sort of hollowing out of the middle of software right after the break. Are you looking to stay ahead of the curve in the latest trends in enterprise tech? Look no further than the Breaking Analysis podcast with Dave Vellante. This data-driven program dives into the most important topics facing the enterprise tech industry today. With a data-first approach that leverages ETR's renowned surveys of IT decision-makers and insight from the Cube community, Breaking Analysis delivers in-depth research on the most important topics facing technologists and IT buyers. Whether you're a business leader, an IT professional, investor, or just an avid follower of the industry, this podcast is a must-listen. Just search Breaking Analysis Podcast wherever you get your podcast and tune in today to stay ahead of the game in enterprise tech. And we're back. And as I mentioned at the top of the show, we're going to dig into a little bit of the, sort of the comments around, the idea that 80% of, while there are lots and lots of companies selling different products, 80% of what they do is pretty much the same. And we don't mean that sort of generically across all of software as if like, ERP software or calendar management software is the same thing as software supply chain software, right? Like, I don't mean it in that way, but I do mean like in the category of, for example, if you said, oh, we do, zero trust security, for example, or we do, I don't know, pick anything. We do data, advanced data management or AI ops or something like that, or, observability. You can look at those companies that sort of fall into that category or want to be in that category or think that's the center of what they do. And you can often look at their webpage. You can look at how they explain themselves. You can look at the verbiage they use to describe themselves, or, how an analyst explains what they do. And if you did sort of a blind taste test, you just said, like, take the name of the company off of there. Do I know which one is which? Oftentimes you're going to, if you're very realistic with yourself, go, no, I don't know that I could tell the difference between them. They all sort of kind of sound the same, and they all will tell you they're the best. And they will all tell you they have lots of customers. But, in terms of, is there a market share study showing them at the top right, sort of Magic Quadrant? Do you have the same customer showing up in their profile 2 or 3 times? Are they all the most securest, fastest, whateverist, automatedest, developer friendliest thing? Yeah, they're all kind of getting in that mold. So we're going to begin to run into an interesting time in which, again, now that money's not cheap and the ability to raise money is not unlimited and can be done at any given time, we're going to see some companies, we're going to see some companies go through some things, as they say. And if we step back, the reason for that is, in general, markets as a whole really typically, and this isn't sort of like a hard and fast economics rule, but in general, markets can't sustain more than sort of 3 significant players in any given category, right? You typically have market leader who will, oftentimes over time have somewhere between 50, 60% of the market, maybe in some cases 70% or some, humongous number. You have sort of a market follower, a strong number 2, who, oftentimes is at least considered in opportunities, may win some, may have some distinct differentiation, but is kind of playing catch up, right? So, maybe 3 or 4 years ago, we would have said like, oh, this would have been like AWS is the market leader and Azure is the second and so forth. And then you typically have sort of a third option, and that third option typically survives either because they do some niche in that space really well, but more oftentimes they're just sort of the low offer, the sort of the low price offer in that space, right? So, in cloud, I guess there's not really a realistic sort of third. Like we often tend to talk about like AWS, Azure, and Google. Google's not really sort of the low cost third option. Maybe that low cost third option is somebody like DigitalOcean or Civo Cloud or any of those things. But those last couple, DigitalOcean or Civo Cloud, really aren't, from a revenue perspective, anywhere in the same ballpark or even in the conversation with an AWS or an Azure. So that's maybe not the best example. Maybe the best an example would be something like, well, you have like Datadog and observability, and then maybe you have like New Relic is say like number 2, or Dynatrace, and then maybe there's a third option that's, again, they're not going to be nearly as big. They're typically going to be, 1/10 the size, but they're going to be the one that people choose as the cheap option, right? And so that's your normal market dynamics for any given market that's kind of matured somewhat in a given category. And that might be because, one of the companies has really just a far better product. In some cases, they have figured out the operational landscape better. They just sell better. They market better. They do all the kind of block and tackle things better. They've created better partnerships, right? This might be, maybe the analogy is something like Red Hat, SUSE, Canonical, right? Red Hat is the biggest. SUSE still has some play in some markets, like with SAP or with Rancher or something. And then Canonical just sort of is the lowest cost, small thing, right? Maybe that's the analogy I'm sort of looking for here. And so, that tends to be what shakes out as markets kind of mature. And granted, a lot of the sort of cloud native markets that we're in maybe haven't necessarily matured. Maybe they're only 3 or 4 years old and they need a little bit longer. I think the thing that's going to kind of tip that scale or accelerate that timeline, obviously, is the interest rates. The ability to re-raise funding is going to be much, much more difficult or much different than it was 2 or 3 years ago. So on one end, you've got the sort of debt market dynamics. The other thing is, when you have 6, 7, 10 companies in any given domain, the market itself just can't understand the differentiation. So while the companies in that space can try and tell you, hey, we're the bestest, greenest, orangest, securest, whateverest, easiest to install, it's too easy for the other companies to kind of co-opt that marketing or to try and find a way to get into that space. And so if you're a customer, you're looking at this and you're like, I don't have time to evaluate 6 to 10 of you. You all sort of sound the same. Your salespeople send me the same stuff. We could do a balanced scorecard. We could figure out who's there, but you're all going to kind of cluster around the same 6 or 7 number, or 7 or 8 or 5 or 6 or whatever it is. So I just don't have the time to kind of differentiate you. And I don't have any really good third-party tools to figure it out, like a Gartner or Forrester. Once they get past a couple that they kind of highlight in their thing, everything else after that is just sort of like, yeah, they do that stuff. They're fine, right? Or using the Cote scale of, fine, and fine. They're somewhere in the 1 to 2 fines range. They're not anywhere in the 2 to 3 fine range. So, that's the other dynamic of it. It's just sort of psychologically, the market can't understand it. They don't have time to process it. And so we're now sort of in the stage when we talk about software. Software has always sort of been proprietary software. So something like an Oracle or a VMware vSphere or whatever, WebEx or something, right? Proprietary closed code software, controlled only by one vendor, distributed by one vendor, that sort of thing. Then you had open source software, which we all know about if you listen to the show for long enough. If you follow the CNCF or just any open source domain, you have kind of open source, which has come along. Typically is not going to necessarily be more featureful than the proprietary stuff. Oftentimes it's kind of following some proprietary stuff in terms of feature set, but it's obviously, in most cases, going to be less expensive because, the premium that you can get for open source software is typically, kind of the premium that you can get for, service and support, which might be 10 or 15% of what would typically be proprietary list price, plus maybe some sort of other premium if you are the dominant player in an open source project, or you create some interesting integration with other products that you have or third-party products or something. So But again, price of that's going to be somewhat lower. And then the third thing in the spectrum is obviously SaaS, right? SaaS being, could be proprietary software, could be open source software, could be somewhere in between. But you are then offering, the as a service component of it. You're operating it for them. You're taking the lifecycle out of it. And so, what we've seen is, SaaS can be delivered at really interesting operational levels because, you're not building hundreds and hundreds of features and hoping that they align to something. You're not building hundreds of features and being like, well, I don't know which 30% of these customers are going to use. You tend to be building features and delivering features based on usage, right? Like could be on a one-off basis. And so you're able to be much more cost effective with what you do. You can scale certain things back. You could be running things on, very cost effective cloud environments and, using ARM and maybe using serverless and using a bunch of, cost control techniques that, may not necessarily be easy to do from a software perspective where you typically have to have larger sales forces and all these sort of things. So what we're seeing is this evolution in which on the lower end, you've got SaaS being able to go after, one or two capabilities. And you can see companies that maybe can survive in that space. It could be Monday.com. They're just going after kind of calendaring and project management, right? Or you could see, things along those lines. But the thing in the middle that is like, well, we're half the features of a Datadog or half the features of a Salesforce, but we're not the 3 or 4 that you really want, or we have 3 or 4 that you want, but we don't have the ones that are, take you. Like those are starting to struggle. And I think what we're seeing and what we're going to end up seeing is sort of 3 scenarios for the middle of software. What I'll call the successful middle, which by that I sort of define it as it's a mid-size company. Maybe you are doing 25 million ARR or 50 million ARR. Maybe you're as big as 100 million, although usually when you get to 100 million ARR, you become, viable for an IPO, right? But, most of them aren't going to break out of the 10 to 50 million ARR. But maybe you are, mid-size and you've got decent growth. So you're showing 20% a year growth, 30% a year growth, maybe 40% a year growth. You're not at 100%. You're not sort of, not in that 2-3-3 sort of model that we like to see. So, sort of the 2-3-3 model, which is like you grow 2x, you go 3x, you go 3x, you get to 100 million, you can IPO. Maybe you're more in the 30 to 50, 30% to 50% growth year over year, right? So you're growing steadily. Maybe you're still burning through, but you've shown your ability to gain traction in the market. You've shown your ability at least to have a blueprint of a model that'll help you grow. And if given the right accelerant, meaning like you get acquired by somebody who has a much bigger sales force and you have a story that's already resonating that they can then repeat and do reliably, or you can pass out to partners, those are likely going to get, probably picked off by a large vendor, right? If you're doing it on your own and you're generating a bunch of money, then you're probably going to get picked off by private equity because they're going to go, oh, okay, there's probably efficiencies that we can take out of what they do. We can show faster acceleration. So you're going to have the sort of successful middle, and then you're going to have the sort of mildly successful middle, which again, the difference between them is sort of nuanced. The successful middle, maybe you're getting picked off by a vendor, maybe you're getting picked up by private equity. The maybe somewhat unsuccessful but really good tech, if you have really good tech, maybe you have mediocre execution, you could get picked off by a vendor because the vendor looks at that and they go, hey, the technology itself is interesting to me. Your execution, I don't worry about because I have my own ability to do sales and marketing and all sorts of stuff. And I can fold you into something because I couldn't build it myself. And then the sort of unsuccessful middle, meaning we have average technology, bad execution. So you don't differentiate in any way, shape, or form. You can't sell it. You can't build a story, right? You are the number 5 through 10 in any given market. You're probably going to go under. You're going to have a hard time raising the next round of funding. And I don't mean this to be in a negative way. Just this is sort of, when we talk about the, everything sounds the same, 80% sounds the same. yes, 80% sounds the same, but if you're not in the more well-known, the better half of the 80% that sounds the same, given that it's going to be very hard again to raise money the next round or raise money at a valuation that's going to inspire people to stick around, like that becomes harder and harder. So, I think we talked a lot over the last 6 months about like what things are going to change going forward. I think we're at the beginning now of, going to see companies that may have been unicorns 2 years ago, 3 years ago, kind of have to determine, am I going to stick with the strategy that I have, which might be too broad, might be undifferentiated, might be not well enough to find, have to figure out, do I have the hubris to say that, well, we just need to keep plowing along and keep struggling? Do you have the insight to realize I probably need to narrow down what I'm doing and maybe sort of shift a little bit towards more that niche side of things and try and, make sure I have good tech, that I can execute. Maybe you don't even have to have good tech. You just can execute. You've realized how to, tell a story that people want to pay for. You can execute against that. You can do it scalably. Maybe you look at what you're doing and you're saying, I'm going to double down on the tech. I'm going to identify some potential exits, right? I'm going to look at the marketplace and say, that company would like to buy me. That company we would fit in really well. That company we would do well. Maybe you're beating that company in the marketplace, and you sort of steer the ship towards being very attractive to them, even if, you're not selling nearly as much. Maybe what you're doing is you're shifting your marketing to be your story, your technology towards being more attractive to them. Or you say, look, we're doing very well. We're kind of willing to move towards private equity, and while that does wipe out a bunch of shareholder, a bunch of your employees' sort of shareholder equity, the owners of the company, somewhat can make out somewhat, and they may want to get out of the company. So, but I do think we have been seeing this sort of not hollowing out, but we've been seeing the formation of what becomes the hollowing out. Too many companies that are overfunded in the middle, too many companies that haven't differentiated themselves. I call out KubeCon because not that the CNCF did anything wrong, but because it is an opportunity to see a lot of vendors in the same place. You could make the same argument at AWS reInvent. You could walk around the floor and be like, there are 10 companies here that all sound exactly the same. Maybe they're in cloud cost management, right? Pick your domain of choice. You're going to walk around, you're going to see 10 or 12 of those. That's, when private equity starts talking about, they're selling different products, probably by name, but 80% of what they do is pretty much the same. That's exactly what they mean. It's, it's the, single line description of what is going on at AWS, AWS reInvent or KubeCon. And it's, it's why every time when, AWS announces a new feature, a new product, you sort of go, well, who's going to get wiped out? That's in essence that. And because we've seen the changing of what it means to get new money, how long they can survive, we're going to begin to see kind of the result of that. And it's natural market evolution. This is not a new phenomenon. It might be new to anybody who hasn't lived through a time in which there wasn't, basically zero interest rate free money available to any idea. But, it is going to be the beginning of what we see. And there's always opportunities, when a market evolves, but typically when you start to see a hollowing out, and you can go look up hollowing out as a general economic trend, it's happened across a lot of industries. This is something that we've been sort of seeing around software for a while. It kind of got propped up again by lots of cheap money over a while, but I think we're going to begin to see sort of this hollowing out in which the companies that will be successful longer term, 5 years from now, will be on either end of the spectrum. They'll either be part of something very, very big. They got acquired into something very big. You will buy into one of those platforms, and those platforms will market themselves as sort of do all, catch all, have everything. Or you're going to see people kind of have to go back to being sort of a niche-y thing and either surviving as a small niche or just realizing that at some point we will, we may end up getting picked off. Being able to grow into that middle becomes very, very difficult. So anyways, so interesting. Again, I've been hitting on a lot of stuff this last feels like 3 or 4 months about, how does the software industry sort of evolve as we're seeing the economics change, and the two of them are intertwined. And that's why we're always sort of talk about following the money. But interesting times, interesting to see kind of the perspective that private equity is now having. Again, not a new perspective from the perspective of private equity, but sort of a new perspective for our industry in terms of, what's been different in the last 5 to 7 to 10 years. So with that, I'm going to wrap it up. Hope everybody's having a good Sunday. Another Sunday Perspectives. Thank you for listening. Hope this was useful. Hope everybody's doing well. For anybody having high school graduations, college graduations, congratulations to the graduates, to the parents, to the families. And with that, I'm going to wrap it up. We will talk to you next week.
Thank you for listening to The Cloudcast. Please visit thecloudcast.net to find more shows, show notes, videos, and everything social media.